Hi everyone, welcome to my new YouTube channel. This channel is going to be a series on financial markets. It's something that I'm really passionate about in my off time. I spend a lot of time researching, looking into different companies, and ultimately trading my own account, which I've been doing for a good number of years now. You're probably wondering why I'm doing kind of a video on it or like a video series. The first reason is kind of just wanting to put something out there about what I do, obviously around this area, around this topic. I used to write a short blog at the weekends, but it typically took me quite a long time to write it. I also don't really journal that well. I know a lot of people get a lot out of journaling and things like that and writing a lot of stuff down, but I think doing this series is probably going to be better for me and myself. I can obviously watch back what we've been talking about to learn from it myself as well. Another reason is I kind of don't enjoy listening to myself talk. It's something that I've never really been able to do properly. Kind of when we do interviews and stuff like that with the hockey, I typically shy away from listening to them back. So I guess it's for me to kind of document what I'm doing, but also to kind of get over that a little bit. Um, it'd be good to kind of share, what I'm doing here in my own time. Before I get started, obviously, I have a degree from NTU in investment management, economics, finance, banking, but I'm not a investment advisor. I don't have any qualification to my name in that regard. So please don't take this as gospel. This is literally just my thoughts, and I'm trying to learn here whilst obviously sharing it with everyone. So please don't take this as advice or please don't go out and put on trades or trade ideas just because I've mentioned it. Um, Another kind of, I guess, disclaimer, which is pretty standard, is just assume everything I talk about, I, own it myself. Um, it's just for not, there's no compliance here, but it's just easier to assume I will buy or sell anything that I talk about, and assume I own everything that we go through, just for ease. So yeah, it's kind of start of a new kind of channel here. I think it's going to be really fun. Um, I would probably watch it on 1.5x speed, just for ease and for audio quality. Yeah, it's super kind of amateur setup. I literally have a mic and a webcam, so um, it's not professional by any means, but I think it's just good to get something out there, and I can start sharing some stuff that I'm doing in real time. I think it's going to be good for me, and obviously, if anyone learns anything whilst whilst they're watching, then that's fantastic. Um, so I guess it'd be good to start by going over kind of, how I got in this or got onto learning about all this stuff. Um, so when I kind of came back to Nottingham at 18, I had a lot of spare time, through the hockey in the afternoons and downtime, which I try to fill as best I can. And I bought this book here, which is, if you can see it, How to Make Money in Stocks. Um, it's a real, quite a big book. And it goes over kind of, William O'Neill is the author and writer and founder of Investors Business Daily, which in the States is a newspaper, or it started out as a newspaper every day. So basically like a stock market newspaper that people would subscribe to, and they would deliver every day. And inside it would have lots of different charts that people could look at, obviously used for kind of research purposes and stuff like that. So this is the fourth edition of the book, and it basically goes over his, I guess, strategy, that you could coin it that. So that kind of it follows an acronym of CAN SLIM. I'm not going to get into that now. Buy the book if you are interested. I think it's only like 10 or 12 pounds, but it taught me well, it's the foundation of everything that I've kind of um, you know built up to now, with a few tweaks here and there. When I read it, the first 100 pages, as you can probably see here, are literally just charts. You can't see that too well, one by one. Um, Historical charts from, I think it's from 1870. Where is it? 1885, 1898, Bethlehem Steel in 1914, all the way up to present day. And the idea behind that is that you study the best winners or best stock market performers of the past, and then you look for clues and characteristics within each one, and you try and build a picture in your mind of if you see something similar in the future, then you've got something to draw upon. They call that precedent analysis, or kind of like a model book to follow. Um, so, you look at all the 100 charts, you think it's really easy, you just buy where it says to buy and then, sell at the top, and then it's super easy. But um, when you go through the whole book, there's a lot to take in, and there's a lot to learn for sure. And then you start doing it in real time, and you think you know everything because you've read one book, and without doing it with your own money and making trades, putting on risk with your own money, and making money and losing money, it's really hard to get any experience, or any valuable experience. A lot of people just, um, what they do is they'll open this risk-free account. So it's basically like free money, virtual trading. Um, and they think that, they put on, huge risk, because the money's not real. And it's not until you actually do it with your own and have the pain of obviously losing money and have the reward of making money that it all starts to become a bit more real, and difficult. It's super difficult, trading and investing. It all ultimately comes down to your personality. I mean, it's the true test of how you're wired as a person. So for me, as an example, um, I would never kind of buy something, watch it go up a lot, and then watch it come down by just as much, and just think, oh, at some point in the future, it'll keep going up. I'm just not, my risk appetite just isn't that way inclined. Um, Typically I want to buy something and ride a trend, and then as soon as it kind of stalls out, I want to get out. So basically, capture the upside move, and then when things become difficult, sidestep some sideways periods or declines, and just keep doing that over and over, and try and compound my money as quick as I can, in the fastest names. But obviously, it's not that straightforward. One big thing in the How to Make Money in Stocks book is, the M in Can Slim, is the market. It's that's what the M stands for, and you kind of glance over that chapter in the book, um, and think, yeah, yeah, the market. Of course, you need the market, but it's not until you really start doing this for a good while. I've been doing this probably, it's 5, 6 years now. It's not until you have that much, time at the screens that you really understand that the market is the most important thing. You can buy anything in a good market and it'll probably go up, but when you're in a bad market, just buying becomes so much more difficult. And it's not until you have to go through, obviously, real strong markets, and then corrections, or due to where the market comes down, like the COVID crash, and the bear market of, I think, 23, 24, when interest rates went really high. You have to have that experience to, ultimately learn from it. And that's why we study what we study. Um, so the idea of the channel is to kind of walk through some key concepts and also study, the examples in the book. So I have a big list here from the book that I want to go over at some point. Again, you can't really see it too well because of the focus, but we're talking the likes of Tesla, Nvidia, Apple, Amazon, Microsoft, all the names people will probably know. But what people probably don't realize is some of the biggest winners of all time have been the likes of Netflix, Costco, eBay, Home Depot, McDonald's, BlackBerry, Booking.com or Priceline, it was used to be called. Um, Taser, which was Axon, or it's now called Axon. Taser was, you know, when police officers first had kind of the self-defense of the tasers, that stock went wild. Um, and we're going to look at different times. There's obviously the Netflix trade, as an example, was between 2008 and 2011, which came off a really bad bear market in the financial crisis. So what you'll see is that when we have these big, global events, often the best kind of opportunities follow that. We'll look at, we got Amgen 1990 all the way through to Robinhood, which is still obviously making a big move as we speak now. But we're going to go right back the way in the years over time, and just try and build a picture of what we're looking for when we study these and how that can hopefully help in the future. So I guess it would be good to just start out by looking at a chart of just the general market, and just kind of go through what it is that we have and how we lay things out. So here we just have a chart of the S&P 500, and for today it's just important to go over kind of the way I lay everything out. So I use a software called TradingView. It's not too expensive. I could definitely be using something better probably, but for what it costs, it's perfect for me. And I have these lines on the chart here. So these are what's called moving averages. So they take a period of time. You can set whatever moving averages you want, and they take an average of the price in that time. And then for each day, there is a new average price. So as an example, this is today's date, which is October 1st. The pink line here is the 10-day exponential moving average. So it takes the last 10 days data. That's an exponential one, which means the weighting of the most recent days is heavier than the days before. So if you're on day 10, your yesterday's data is more important than day 10. There is also a simple average, which here is the red one, which there's no weighting in it. It's just the straight average of the last 50 days for the red one, and it's 200 days for the black one. And then the green one, which is the most important one, is the 21-day moving average. So you can see here, we've got bars, we use candlesticks, and then we have pink, green, red, and black. And what you want to see is them all stacked on top of each other in that order, which shows as a healthy market. The candlesticks, so if we take, oops. If we take this picture here as an example, so a blue candlestick is when it closes up for the day, and a red one is when it closes down. As you can see here, there's a wick, what's called a wick here at the bottom. So that line, that means that it opened at a certain price, it came down, and then because the body of the candle, which is the blue bit here, because it's blue, it means it closed higher than it opened. So it came down to the bottom of where the line is, and then went past the open and closed up here. So again, I can show that through here. So it opened here, came down, and then closed up here. The red one, as an example, it would open here near the top. Okay, it would push up a little bit because there is a tiny little wick at the top here, and then it would come all the way down to here, and then it would rally up a little bit and close there. So that's why it's red, because the open is here and the close is down there. But I'm probably not going to walk through all the different formations and stuff for the candles because I've not done that much research in it. I think all you need to know is the high, low, open, and close, and you can build a picture using the moving averages of the chart and stuff like that. So um, this is, like I said, the S&P 500 today. So this is live. And you can see here we had this, correction, this kind of crash down recently in April. This was when Trump was imposing all of his new tariffs. But it shows obviously the market's bounced back, a great amount. It shows the market doesn't really care about the tariffs. It was just a shock event. So we came down from the high. We came down 21% just on the S&P 500, which is like an index. It's typically what we follow to track the overall market. And then from the lows, we've rallied up 38%. So a good rally so far. Definitely not done yet by the looks of it. Um, but this is kind of the layout that I use with these moving averages. And what it does is it just helps me, follow the trend, really heavily rely on the green line, which is the 21 day. Now, the reason that we use a 21 day is typically it acts as really good level of support and it kind of fits with the time frame that I want to trade in. So as an example, I'm not like a day trader where you're buying, holding for 10 minutes and selling and trying to make money. That's just not it doesn't fit with kind of the lifestyle that I have and how I want to do it. But there's nothing wrong with that. Having said that, I typically want to ride the trends here. So I can kind of show you. Yeah, let's see if this works. So, when it's above the green line, typically that's good. When it's below, it's bad. So you can see when it gets below here. Use the arrows. See if that works. Yeah, so you want to stay below, well, stay out when it's below here. And then obviously it gets above here and it goes all the way um, up there. So this is what I want to be capturing if I can. All right, these trends and then sidestepping when it gets difficult. So you can see back here as well, a similar thing. We had a correction here in what would that have been? July 23. Okay. If I can, perfect. So this is really tricky in here. Obviously it goes down, then back up, down again, back up, down again for the third time. But then when you get above your 21 day, which is the green line, and you stay above it, you start to trend really nicely. So again, it's this area that I'm looking for and staying out of this one. Which you're trying to do as much as you can. Again, it's harder than it seems. It's really difficult trading. I think if you've been in the markets long enough, you kind of learn how tough it can be. Having said that, there are a lot of opportunities and a lot of money to be made. People obviously do this full time. That's their career, and it's something that I'm obviously building towards very slowly. I'm not saying that, it's going to be my career by any stretch, but I'm just trying to do my thing, staying in my lane with what I want to do with my money. And then, if I can build up a reputation and a track record, then fantastic. I suppose it's a good place to say as well, if you're still watching, this is all done in my own time. It's nothing, doesn't impact my work in any way. Obviously, playing ice hockey with the Panthers is my main priority, and this is all done on my own. So, any views or anything like that, we're not talking about hockey on here. This is just for me. No one might watch this, which is fine. This is for me to kind of learn, learn over time. Like we said, studying all those big winners of the past and going over concepts in the market too. That I think it's just more beneficial for me to do this than it is to, do it quietly in journal. I think I need to put stuff out there and make people, aware of what I'm doing and also, I feel like over here in the UK, there's not that much um, kind of stuff out there about investing in the markets or anything like that. It's the done thing in the US, but it seems like over here, people are quite more risk averse as opposed to Americans, which is absolutely fine. But if you want to take risk with parts of your money, then there should be places you can go to do that. And I think over time, if I can build a track record and people trust me, then hopefully that they'll trust me enough to be able to do that for them. I'm a long way from doing that. I would have to have proper qualifications and stuff like that to um, be able to take on board money and manage it for people, professionally. However, I do actually verify my track record through a platform called DarwinX, which is where I have my account. My trading account is through them. Basically, every trade I make goes onto a public kind of forum. And DarwinX is a fantastic company. They've got a really clever model of they basically copy trade each account. So what they do is they put you onto a leaderboard, and it gives you an opportunity to verify your track record. So as an example, what do I mean by that is, let's just say you have money in an account and you trade it yourself, and you say, "Oh, I'm up 300% this year." Um, no one's no one can verify that apart from you. And it's basically your word against everybody else's. Whereas on DarwinX, what they do is they basically publish your returns online, and anyone can see it. So if you say you're up 20% and you're actually up 10, someone can go online and look and see that you're up 10 and not 20. um, so realistically, it gives, it cuts out you know, all the people basically lying about their returns. It's the only way I've found of trying to verify myself whilst also learning and doing this. And by submitting yourself to the leaderboard, which is what I've done, people can invest in your strategy if they want to on the platform. Again, this is not me pushing that or plugging that. I'm just saying that's where I have my account. So for anyone that's interested, you can go online. My acronym on the DarwinX platform is JKG. Um, Again, not pushing people there. I'm just saying this is fully legit what I'm doing. It's out there for the world to see. There's nothing to hide behind, good or bad returns. You can go online and look. Um, it's nice to be back doing this. We've had some stuff going on here, which has taken a lot of my time, but it's nice to be back. Um, putting in a lot of work to obviously improve what I'm doing. And this show is going to be part of doing that. Um, so yeah, I know it's really good to put stuff out, and I think, I want to learn more. And if other people can learn along the way, or just have a general interest, then that's amazing. Feel free to comment on the videos if you think it's interesting, or if it's not, then that's fine too. I'm not forcing anyone to watch these. But I think people should really invest from a young age to kind of set themselves apart later in life. I'm not going to do a big spiel on why, but um, a lot of people rely on their pensions when they retire, and it's pretty common that pension funds don't actually outperform the general market. If I just share my screen again, it's pretty common that pension funds, average around, I think it's 6 to 10%. But if I go to a monthly chart of the S&P 500, just wait for it to load up. All my drawings. Let me remove those. You can see that over time the market does trend higher. There are times of bad corrections. This is the dot-com bubble in 2000. So the S&P 500 went down 49%. Okay, so that's a lot. You've got the Great Recession in 2008, that was 56% on the S&P. You've got COVID here. The COVID crash was 35%. So, you know, along the way, it's a steady trend up, but it's whether you can handle that, volatility down. And there's always a chance that that can happen. Not every day, of course, but there's these big global events that happen that cause, corrections. There's, like I said, 2020, there was Brexit 2018, which we'll go over at some point. There was, oh no, sorry, 2016 was Brexit, I think, in here. 2018 was the Fed Chair Powell, interest rate decision on, I think it was Christmas Eve, which there was, then started the new uptrend. There was, like I said earlier, I think, 2022 to 23 was the interest rate hiking cycle with really bad inflation. So there's always things going on. But having said that, look at the opportunities that there are. Just as an example, from the lows, 2008, 2009, to where is it, 2011, up 50%. Okay. And then hit some volatility, up again, breaking out of here, up this trend here, 55%. Okay. Volatility back here, this trend, 34%. Okay, the current one that we're in, like I said earlier, 38%, big shakeout month here. This is a monthly chart. So again, I think these bars look tiny, but there's some really good money to be made if you want to learn, want to, put money at risk. Like I said earlier, it's not for everyone, but I think everyone should take a portion of their money um, and invest it, over time. That things go up. That doesn't mean you just buy it and hold it forever, because that's not my strategy, not my style. But I do think there's something to be said about getting in these trends here, um, and riding them until they fall apart. That's the whole game. And it gets difficult, it gets choppy, it gets frustrating. All the emotions that you could probably feel, work or hobbies or whatever, you feel them 10 times more in this, because obviously there's money at stake too. Um, but I think given enough time and effort and energy, the rewards are there for great things to happen. And I think it takes a lot of hard work and study in the past, but there's definitely opportunities, and we're going to walk through, like I said, some of the ones of the past to learn for the future. So that's probably a good place to kind of end it for the first one. Just an introduction to the series. Really looking forward to going over, like I said, a lot of concepts, principles, and kind of walk through how I do things. But yeah, this is more for me just to look at the case studies, over and over again, and try and ingrain it in my brain of seeing these pictures, and taking Netflix as an example and saying, oh, it looks like another one in the future, and kind of using that to build a precedent, so that I can see Netflix did this. Is it in the same character, or because every stock in the market has a different character. There are high flyers, there are slow ones. Um, so yeah, thanks for listening. Anyway, I'm rambling on now, so I'll cut it off here. But great to be doing this. And like I said, this is all in my own time. My views are my own, so don't take them as investment advice. But thanks for watching, and we'll be back soon with some more.